Hi everyone, welcome to CRE360 Weekly Market Intelligence. Today we'll walk you through the core drivers of commercial real estate: capital and rate, credit and lending, valuation, and capital flow. This segment is part of our larger weekly report, which goes deeper into risk, insurance, and full property fundamentals across every single sector, from multifamily to hospitality. To access the full report and future releases, please make sure to subscribe to our channel and our website CRE360.ai. Let's get started with capital and rate, where it all begins. Last week, the bond market made the call, and this week it was proven right. Yields slipped, credit steadied, and money finally started to move again. Fed hasn't cut the rate yet, but the curve already has. 10 years yield drifted below 4, and the 2 years holding in the mid-3s. So borrowers who can move now can lock in meaningful savings before the next floor forms, as term sheets are reappearing and liquidity is quietly flowing back toward quality. For the first time this year, the window feels open, not just for talk, but for execution. Let's see if the data verifies that.
SOFR fixed near 4.3%, reflecting light quarter-end pressure. Treasury yields eased 5 to 10 basis points. The 2-year at 3.41, 5-year 3.55, 10-year 3.99. FedWatch holds a 100% probability of an October cut and signals another by December. High yield near 3%, both unchanged after last week's volatility. MSCI data indicates cap rate stability, while TREP shows special servicing at 10.6%, still concentrated in office. In short, rates are easing, spreads are stable, and the first phase of capital thaw is underway.
Credit is holding the line, and right now that's a quiet win. Liquidity hasn't expanded, but is staying loyal to the well-structured deals. In this phase, structure matters more than rates. Think of it as a static rent. It carries disciplined borrowers forward, but it won't rescue weak boats. That's why most are leaning on partial interest only to protect the SCR and targeting 5 to 7 years paper where flexibility matters most. Pipelines are busy into year-end and execution risk is needed, but credit standards remain tight by design. Let's take a look at the data and see what data shows.
The numbers tell the same story. Conduit AAA held in the plus 76 to plus 78 basis point range over treasuries, and CRE CLO AAA stayed near plus 130 according to CRBE. Senior core spreads remained steady in the 170 to 190 band. Also, all-in coupons were unchanged. Underwriting metrics reinforce that balance. DSCR between 1.7 and 1.9 times and LTV around 56 to 57%, debt yield near 12 to 13%, and partial interest only common across asset classes. One bright spot, September C. MBS delinquencies improved 6 basis points to 7.23%.
We have entered the holding pattern. Price discovery is largely done. Values aren't falling, they're curing, and confidence is rebuilding. Stabilized pricing allows investors to move from hesitation to execution, and capital is returning to the sector that never lost their footing, like logistics, housing, and anchor retails. From here, value creation comes from strategy, not compression. As value holds, capital starts to flow again. Let's take a look at the data and see if that verifies.
The data back that view. Stability across the board. The all-property cap rate held at 6.84%, unchanged since early 2025. Green Street's commercial property price index ticked up 0.2% month over month for a 2.9% annual gain. MSCI's RCA index shows a similar 2.4% year-over-year increase, confirming a stabilized valuation base, widening the property yield spread to about 284 basis points. Investor sentiment remains neutral to positive, with most participants no longer expecting further cap rate expansion. Values appear to be holding the bottom of the cycle, with early signs of gradual recovery.
After a long freeze, the river is finally moving. Capital flowing again, but the current is still shallow. Private credit and family offices are stepping in first, while global capital awaits at the edge, watching rates settle. For operators, this is the time to refinance, de-risk, and hedge while the water is calm. For investors, the play is recapitalization over speculations. We're not in a full recovery yet, but the current has direction, and the opportunity has started to surface. Let's take a look at capital flow analysis.
U.S. commercial real estate is edging forward. MSCI data show annualized sales near $425 billion, the strongest pace since early 2024, led by multifamily and industrial. TREP reports distressed loan balances rising slightly to $118 billion, with hotels and retail adding to the watch list, and office still accounting for roughly half of all distress. Refinance exposure through 2026 sits near $1.6 trillion, but lower Treasury yields, now back under 4%. Dry powder is up to $355 billion, proving liquidity exists, even if conviction hasn't caught up yet. Distressed sales rose to 3.2% of transactions, signaling stress pockets, not systemic strain.
Thanks for watching our weekly market intelligence. To access the full report, charts, and analysis, as well as property fundamentals, subscribe at CRE360.ai. See you all next week.